Imagine a company that's, well, not just building infrastructure, but the very backbone of our digital future. Think smart cities, national security, cutting-edge AI data centers. Now picture that same company, Gorilla Technology Group Inc., ticker GRRR, trading around, what, $20.24 a share? Some analysts are forecasting it could hit the mid-30s. Yet here's the twist. A significant chunk of the market is actively betting against it. So is this a hidden gem? Poised to architect a new era? Or is its incredibly ambitious strategy just a house of cards, built on contracts that might never fully materialize? It really feels like Gorilla's future hinges on a razor's edge. Welcome to the Deep Dive. This is where we unpack your source material, distilling the most important nuggets of knowledge and insight for you. Today we're diving deep into Gorilla Technology Group Inc., ticker GRRR. It's a fascinating one. We've got a comprehensive report right here, analyzed as of September 17th, 2025. Our mission for you: to cut through the noise, understand its core business, its financial health, what the market thinks, and crucially, the big risks and opportunities shaping its story.
Let's dig in. Okay, so we're going to think off with Chapter 1, Business Analysis. The central question this report seems to be wrestling with is this: has Gorilla Technology, with this huge multi-billion-dollar pipeline and its specialized AI solutions, really positioned itself to become a critical, maybe overlooked architect of this new digital era? Or is its ambitious strategy more of a high-stakes gamble on contracts that might not fully translate into revenue? Again, we're looking at this as of September 17th, 2025, share price $20.24.
Right. And what's really key to understand from the get-go is Gorilla's business model transformation. It's really shifted. They've moved from being, mostly a product-centric software company to becoming a fully integrated end-to-end AI infrastructure and technology partner. So now they're laser-focused on landing and executing these massive, complex, multi-year contracts. We're talking governments, large enterprises. Think of it like this. Instead of a client juggling multiple vendors for different parts of a big, complex project, Gorilla steps in as the single point of contact, the one throat to choke, as they put it.
Right. Simplifies things for the client.
Exactly. It reduces complexity, reduces risk. They cover everything from smart city development, national security, critical infrastructure like smart ports, smart airports, even environmental intelligence stuff. A really good example is that huge $1.4 billion three-year contract they signed with Freyr Singapore.
Yeah, that one made headlines.
It did. They're building AI-powered data centers, providing their own proprietary AI stack, GPU as a service infrastructure, and they're even managing the long-term operations. It's a full-service, soup-to-nuts kind of deal.
And their offerings really reflect that comprehensive strategy. You can sort of break them down into three main buckets, right? First, there's video analytics and AI solutions. That's their history, their core. Their intelligent video analytics, or IVA platform, doing real-time analysis, facial recognition, license plates, object detection, things like that. Products like IVR, which is intelligent video analytics recognition, and EVMS, their enterprise video management system, crucial for smart cities. Second, cybersecurity solutions. This is interesting. They've got a security convergence platform protecting both traditional IT assets and, critically, OT operational technology. Think industrial control systems. Their cybersecurity intelligence uses AI for real-time threat detection. Solutions like NetProbe, NetTrap, and SD-WAN. That's software-defined wide-area networking. They even did that for a whole country in Africa, right?
That's right, yeah. A national-scale implementation.
And finally, edge AI and IoT solutions. Basically bringing AI processing right to the source of the data, the edge, for quicker decisions. Integrates with all those Internet of Things devices for connected infrastructure.
And it's really important to get a handle on Gorilla's scale here. Technically, they're a small-cap global player, HQ in London, but deep roots in Taiwan. But don't let small-cap fool you. Their projected revenue for fiscal 25 is around $99.7 million. Okay? Now, compare that to their qualified global pipeline of opportunities. This is valued somewhere between an incredible $5.6 billion and $6.6 billion.
Wow, that's up to 60 times their projected annual revenue.
Exactly. It's staggering. And they also have a signed backlog of $93 million just for 2025. They're strategically targeting these high-growth emerging markets, Southeast Asia, Latin America, the Middle East. They're showing this ability to really, punch above their weight class, winning contracts that are just orders of magnitude bigger than their current size.
So what's the pitch to clients? What's the core appeal?
It boils down to delivering these highly customized, mission-critical, integrated AI solutions. They leverage over 2 decades of experience, deep technical know-how. For the clients, it's about managing immense complexity. Having that single accountable partner drastically cuts down risk and ensures these huge transformative projects actually get executed cohesively. It's about trust in really high-stakes situations. And that leads us nicely into the broader industry picture. Gorilla's playing in markets with some serious tailwinds behind them. Take the video analytics market, projected to grow from about $12.7 billion in 2024 to nearly $38 billion by 2030. That's a CAGR, compound annual growth rate of 19.5%.
Strong growth.
Very strong. Then there's the AI and security market, forecasted to go from $19 billion in 2023 up to over $122 billion by 2033, a CAGR of 20.5%. But the real behemoth is the smart cities market, estimated at $877 billion in 2024, projected to hit an unbelievable $3.76 trillion by 2030.
Trillion. Wow.
Growing at a CAGR of 29.4%, just massive potential.
And here's where it gets really interesting for you. These aren't just abstract big numbers. They represent a truly vast total addressable market, a huge pool of opportunity for Gorilla's integrated approach for years, potentially decades to come. Now, looking at competitors, the landscape seems pretty fragmented. You got direct peers like Cerence, Consensus Cloud Solutions, CRNC, and CCSI are the tickers there. Gorilla actually boasts a better 3-year revenue CAGR, 31.61% compared to them. But, and this is key, it currently has negative TTM EBITDA, that's earnings before interest, taxes, depreciation, and amortization over the trailing 12 months. Unlike Consensus Cloud, which is highly profitable with a 48% EBITDA margin.
Right, profitability is a key difference there.
And then for those really huge infrastructure deals, they're often bumping up against the giant systems integrators like IBM, Accenture. But Gorilla positions itself as more nimble, more specialized, maybe more cost-effective, especially in those complex emerging markets where the big guys might be a bit slower on their feet.
The regulatory environment is definitely a double-edged sword for them. Things like the EU's GDPR, the General Data Protection Regulation, especially around data privacy and human rights, with facial recognition tech. They create compliance hurdles, no doubt.
Right.
But those same rules, plus public procurement laws like Taiwan's Government Procurement Act, they also act as pretty significant barriers to entry.
Okay. So it helps keep out newer, smaller players.
Exactly. It favors established companies like Gorilla who already have the experience, the legal frameworks to navigate all that complexity. It makes it harder for newcomers to just jump in.
And speaking of barriers to entry, they seem really substantial here, like deep moats around the business. We're talking deep technical, domain-specific expertise built over years, 29 granted patents protecting their AI, established relationships with governments forged over time, and those incredibly high switching costs. Once their systems are embedded, especially for mission-critical stuff, it creates a powerful lock-in effect, doesn't it?
Absolutely. The operational risk, the cost, the sheer complexity for a client to rip out Gorilla's system and put in something else, it's immense.
Plus, the capital required is huge, like that recent $105 million equity raise they did, specifically to fund bid bonds and guarantees just so they could compete for these multi-billion-dollar contracts.
Right. So their competitive advantage isn't really about being the cheapest option. In fact, we're seeing their gross margins compress.
Yeah, you mentioned that, from almost 70% down to 40-50% guidance.
That's because of these new hardware-heavy projects. So their strength isn't cost leadership. It's more about a few key things. They've got brand recognition in their niche, a 22-year track record. They're actively working on investor relations. But the most powerful advantage, it's probably those network effects and, crucially, the switching costs. When Gorilla's platform becomes the central nervous system for a city or a nation's security, switching becomes incredibly risky and expensive. That fosters these really sticky long-term relationships. And their unique capability is that full-stack or turnkey approach, managing the whole life cycle of these incredibly complex AI projects design, integrating third-party hardware, long-term operation. It lets them tackle stuff many smaller competitors just can't handle.
Okay, let's shift gears. Moving on to Chapter 2, Management Evaluation. Let's talk leadership. The CEO is Jay Chandan. He came on board in September 2022. His background seems heavy on finance, M&A, SPACs, special purpose acquisition companies, which actually aligns pretty well with Gorilla's aggressive global expansion and M&A strategy.
It does seem like a good fit for where they are now.
Yeah, but the report flags something interesting. The average tenures for management, 1.7 years, and the board, 2.9 years, are relatively short. That could potentially introduce some execution risk during this really rapid growth phase. Something for you to keep in mind.
That's a fair point. Consistency can be valuable during transformation.
On the plus side, management seems proactive when facing crises. They publicly push back hard against short seller reports, even reached a legal settlement. And a really significant milestone was sorting out their financial control weaknesses and becoming fully Sarbanes-Oxley, or SOX, compliant in 2024. That adds a lot of credibility, right? Bolsters their internal processes.
Absolutely. SOX compliance is a big deal, especially for companies operating globally and seeking institutional investment. It signals maturity and robust controls. In terms of transparency, they seem to communicate regularly, press releases, earnings calls, though it's worth noting they use a paid IR firm, RedChip Companies. And the report specifically mentions RedChip intends to sell its stock compensation immediately when it vests. It's just a detail, but something for investors to be aware of regarding the IR firm's incentives.
Good point. Okay, let's talk capital allocation. How are they deploying their money?
Well, the primary focus is clearly on aggressive growth. Expanding globally new offices in Thailand, hiring experienced execs like Satish Venkatesan for the Americas, and their M&A strategy is just as active. They acquired Sequester, and there are pending deals for another AI firm and 2 Thai tech providers, CNS and CANS.
And all this expansion, organic and M&A, is being funded significantly by that big $105 million equity offering we talked about.
Correct. That raise was explicitly earmarked for both organic growth initiatives and acquisitions.
But then, what's really interesting is the board also authorized a $10 million share repurchase program. And they've already bought back $5.4 million worth by May 2025.
Right. That sends a pretty strong signal of management's confidence. They've publicly said they believe the stock is grossly undervalued.
So they're buying back shares while also raising capital. Seems a bit contradictory.
It does on the surface. But think about the logic. That $105 million equity raise, yes, it was dilutive to existing shareholders, increased the share count, but it was arguably a strategic necessity, a war chest, basically. Needed to gain financial credibility, to post those huge bid bonds, and to genuinely compete for the multi-billion-dollar contracts that are central to their whole strategy. Without it, they might not even be at the table for those deals.
Okay, so the raise was about enabling the big game plan.
Precisely. And then the share buyback, even though it's smaller in scale, acts as this critical signaling device. It shows management has conviction in the company's future value, that they believe the market is mispricing it right now. They're putting their money where their mouth is, eating their own cooking.
Got it. What about return on invested capital, ROIC?
That's tricky for Gorilla right now. Because they're in such a transformative phase and things are volatile, looking backwards isn't very helpful. Their TTM ROIC has swung wildly from like negative 64% to plus 17%.
So past performance isn't a reliable guide here.
Not really. The focus has to be on future ROIC. The whole investment thesis is built on this J-curve idea.
Explain that again.
Sure. Right now, returns are suppressed because they're spending heavily upfront on these huge complex projects. Lots of investment before the big revenue flows in. The bet is that they'll emerge into the profitable, upward sloping part of that J-curve as these projects mature and start generating cash. We're seeing maybe some early signs. They reported a positive adjusted EBITDA of $5.7 million for the first half of 2025. That strips out some non-cash charges and gives a slightly clearer view of underlying operational profitability, even if it's early days.
Okay, interesting. Let's move to Chapter 3, financial analysis. Let's get a snapshot of the key numbers for this company in transition. Share price, $20.24. Market cap around $410 million, definitely small cap territory, implying higher growth potential, but also, higher risk. Forward PE ratio is 18.48x. Price sales on a trailing 12-month basis is about 3.07x. Debt to equity looks pretty good, low at 18.4%. And the current ratio, a measure of short-term liquidity, is healthy at 2.16.
Yeah, and that revenue growth has been, well, explosive, but also a bit choppy. They had that incredible 189% year-over-year jump in 2023, hitting $64.7 million. Then, in the first half of 2025, revenue was up 90.2% to $39.3 million. Management's guiding for $100 million to $110 million for the full fiscal year 2025. That's still over 33% growth.
And analysts see that continuing.
They do. Projections are around $127 million for 2026 and then maybe $189 million in 2027. So continued strong top-line growth is expected.
But profit margins, That's the critical area, especially with the business model shift, right?
Absolutely. We talked about gross margins compressing from that high near 70% in 2023 down to the 40-50% guidance for 2025, or about 35% TTM. That's directly because of the hardware involved in these big infrastructure
They're
projects.
profitable, inherently.
Generally, yes, compared to pure software. And operating and net profit margins have been consistently negative on a TTM basis, with net margin around 80%. But again, that positive adjusted EBITDA of $5.7 million for H1 2025 is important. It suggests the underlying operations might be starting to turn profitable before you factor in depreciation, interest, and taxes.
What about cash flow, free cash flow generation?
Historically negative. TTM cash from operations was about negative $31 million. They did see a tiny positive number in Q2 2025, like $280,000. That's not a sustainable trend yet.
So that's the J curve in action again, spending cash now for future returns.
Exactly. The business model just requires significant upfront investment before the revenue really kicks in. This leads to a reliance on external capital, which is definitely a key financial risk for you to monitor closely.
Okay, so zooming out on financial stability. No history of consistent earnings, that's a primary risk.
Correct. Volatility is the name of the game right now.
But the balance sheet looks strong, actually improving. They've reduced debt, got that low debt-to-equity ratio of 18.4% or 0.18. That gives them flexibility.
Financial flexibility is definitely a plus.
And that current ratio, 2.16 to 2.48, is healthy. So immediate cash crunch risk seems low. They have ample working capital.
Right. And no dividend, as we mentioned, not expected either. Typical for a growth company reinvesting everything.
How about valuation? How does it stack up?
Well, trailing PE isn't useful because of the past losses, so we look at the forward PE, that 18.48x, comparing it to peers. Consensus Cloud is much lower at 5x, Cerence is higher at 23x, Gorilla's kind of in the middle. That suggests the market is already pricing in substantial earnings growth down the line.
And the intrinsic value, the DCF analysis.
Right, the discounted cash flow model, which tries to estimate value based on future cash flows. Our educational model uses assumptions like strong initial revenue growth, 33%, 28%, 48% in the first 3 years.
Tapering down later.
Yeah, tapering down gradually to a 3.0% terminal growth rate. And we used a discount rate, or WACC, of 12.0%. That's kind of the tech sector average, plus a premium for small cap risk, execution risk, geopolitical risk.
So adding a buffer for the uncertainties.
Exactly. Based on that, our educational model estimates an intrinsic value range of roughly $22 to $35 per share.
But that comes with a big caveat.
Huge caveat. That valuation is highly sensitive to them actually pulling off this aggressive growth strategy and improving those margins. Execution is everything here.
Okay, let's move into part 2 now, kicking off with chapter 4. Market sentiment. How's the market actually feeling about Gorilla?
Well, if you look at Wall Street analysts, they seem pretty bullish. The consensus rating is a buy. The average one-year price target is $28.50. And the range is quite wide, from $22 on the low end up to $35 or even $36.75 the high end. So clearly, the analyst community sees significant potential upside from where the stock is trading now.
And recent news has been generally positive.
Largely, yes. Mostly driven by company press releases announcing contract wins and progress. The biggest news around our analysis date, September 17th, 2025, was definitely that $1.4 billion Freer Singapore contract for AI data centers.
That $300 million initial phase must have helped.
Oh, absolutely. That was seen as a huge validation of their strategy and likely a major catalyst for the stock's recent positive movement. Plus, other things like the 5G lawful interception deals, the One Amazon environmental project. Lots of positive announcements.
Okay, but here's where that tension comes back in, that contradiction we mentioned at the start.
Right, the short interest.
Exactly. Despite the bullish analysts and positive news, short interest is really high, somewhere between 10.6% and almost 13% of the float. That's substantial.
It really is. It creates this classic battleground stock scenario. You've got the bulls laser focused on that massive growth potential, the pipeline, the big contract wins. And then you have the bears who are deeply skeptical about execution, the lack of consistent profits, the operational risks, geopolitical risks. They're betting against it.
And the technical indicators, the moving averages.
The technical picture suggests maybe a critical juncture. The stock price, around $20.24, seems to have recently broken above its key 50-day and 200-day simple moving averages. Those were hovering in the $17 to $18 range.
So technically, that could signal a new uptrend, if it holds.
Potentially, yeah. Technicians often see that as a bullish sign, suggesting a possible shift in momentum. but if it holds is the key phrase.
So what does this divergence mean for you, the listener? This split between optimistic analysts and high short interest?
It means the market is essentially pricing in a very uncertain, almost binary future outcome. It's polarized. The bulls are betting big on Gorilla successfully converting that massive pipeline into real, profitable revenue. The bears are equally convinced they won't, pointing to the historical losses, the cash burn, the execution hurdles, the external risks.
And the stock price hover near those moving averages sort of reflects that indecision.
Precisely. It technically represents this market uncertainty, this tug of war. The stock seems poised, waiting for a definitive catalyst, either positive or negative, to really set its direction.
Fascinating. Okay, let's look at Chapter 5, ownership structure. Who actually owns Gorilla stock?
Well, institutional ownership is still relatively low, but it's growing. Somewhere between, say, 8.4% and 14% of the outstanding shares are held by about 70 institutions. The largest holder is Alyeska Investment Group with around 7.8%. You see names like Citadel, State Street in there too. But the really crucial piece of news here was that $100 million investment back in July 2025. It came from a single new fundamental institutional investor.
A big stamp of approval from a sophisticated player.
Exactly. A major vote of confidence. That kind of significant buy-in can really change the perception of a stock.
And what about insiders, management and directors?
This is another really compelling part of the story. Insider ownership is high, and it's been growing. It's nearly 20% of the shares now.
Wow, almost a fifth of the company.
Yeah, that shows really strong alignment of interests. Management has significant skin in the game. CEO Jay Chandan himself owns about 0.71%. And what's more, insiders, directors, officers were actively buying shares on the open market back in April and May 2025.
Buying with their own money.
Right. Reinforcing that belief we talked about, that they think the stock is significantly undervalued. They're eating their own cooking, putting their own capital to work alongside shareholders.
That's a powerful signal. How concentrated is the ownership overall?
Despite that big insider stake, overall ownership is actually pretty diffuse. The largest institution holds less than 8%. Retail investors still hold the majority, over 80%. And the top 25 shareholders combined own less than 17% of the company. So there isn't one dominant controlling entity.
Which means less risk of a huge block being dumped on the market.
Potentially, yeah, reduces that specific risk. But it also means there isn't one massive anchor investor providing long-term stability, perhaps.
So this ownership profile kind of tells the story of Gorilla's journey, doesn't it?
I think it does. Going public via SPAC often results in that initial heavy retail base. But you're seeing a clear shift now, growing institutional interest, highlighted by that big $100 million investment. That influx of sophisticated capital combined with the strong insider ownership provides this really crucial bridge of credibility. It suggests the market might be starting to see Gorilla differently, potentially leading to a re-rating of the stock as it matures.
Interesting transition. Okay, let's tackle Chapter 6, risk assessment. Can we break this down with a SWOT analysis? Strengths, weaknesses, opportunities, threats?
Sure. Let's start with strengths. We've covered some of these. Proprietary AI backed by 29 patents, that growing backlog, $93 million, and the massive multi-billion-dollar pipeline up to $6.6 billion, high insider ownership approaching 20%, and those established government relationships.
Okay, clear strengths. What about weaknesses?
Key weaknesses include that inconsistent profitability and the history of negative free cash flow. Significant shareholder dilution is another one. A 158% increase in shares outstanding is substantial. High execution risk on these really complex international projects. And, as we noted, a relatively new management team still proving itself in this rapid growth phase.
Got it. Opportunities.
The biggest is that massive total addressable market smart cities, AI, IoT security, huge runway there. Clear opportunities for global expansion, especially targeting the Americas and the Middle East. High-profile ESG initiatives like One Amazon could attract certain investors. And interestingly, that high short interest creates the potential for a short squeeze, although that's always speculative.
Right, not something to bank on. And finally, threats.
Intense competition is a major one, from both large integrators and niche players. Significant geopolitical risk, particularly around Taiwan-China tensions, given their roots and operations. Foreign currency exchange risk. The report mentions the Egyptian pound, EGP, as an example of volatility impacting them. Then there's the risk of a macroeconomic slowdown hitting government spending, which could delay or kill projects in their pipeline, and very specifically, the impact of those 2025 U.S.-imposed tariffs on tech hardware supply chains.
Yeah, let's dig into those macroeconomic factors a bit more. High inflation, high interest rates, recession risk.
Yeah.
How vulnerable are they?
They're quite sensitive. High inflation can directly squeeze their margins, especially if they've signed fixed price contracts. It increases their costs for hardware, labor, everything. High interest rates make debt more expensive, which could impact their ability to finance new large projects or acquisitions. But perhaps the biggest macro threat is a global recession. If governments worldwide tighten their belts and delay or cancel major infrastructure spending, that directly threatens Gorilla's ability to convert that huge pipeline into actual revenue. That's a core risk.
And those specific U.S. tariffs from 2025, how big a deal is that?
The report flags this as a specific and material threat. These new policies are imposing hefty tariffs, estimated 32% on goods from Taiwan, maybe 19–20% on goods from Southeast Asia.
And Gorilla's right in the middle of that.
Directly in the crosshairs. Their operational HQ is in Taiwan, and they're heavily expanding in Southeast Asia. Their supply chain for essential IT hardware, servers, routers, switches is going to be hit. The estimate is a potential 5–20% increase on the cost of these components. That flows directly into their cost of goods, sold, key GS, and puts further pressure on those already compressing gross margins.
So what can management do?
They face tough choices. Absorb the costs. That hurts margins even more. Pass the costs on to customers. That makes their bids less competitive. Undertake costly, complex supply chain reengineering to source from elsewhere. That takes time and money. There is maybe a silver lining, though. If Gorilla navigates these tariff complexities better than its competitors, especially those heavily reliant on mainland China, which faces the highest tariffs, it could potentially create a competitive advantage. But it's definitely a significant headwind right now.
Okay, makes sense. Let's bring it all together in Chapter 7. Conclusion. Let's synthesize these findings. Can you recap the bull case for Gorilla for us? Sure. The bull case essentially rests on their strategic positioning. They're right in the sweet spot of multiple, powerful, long-term growth markets. Smart cities, AI, IoT. They have that enormous $6 billion plus project pipeline as potential fuel for growth, validated by recent big wins like the $1.4 billion Freyr contract. And it's a big if, they execute effectively on converting this pipeline, their current valuation looks deeply discounted. This view is supported by their strengthening balance sheet, low debt, the growing interest from institutions, and that really strong insider ownership and recent buying activity. The potential upside, if they deliver, is substantial.
All right, clear bull case. Now, flip side, what's the bear case?
The bear case centers squarely on execution risk. These are exceptionally large, incredibly complex projects, often in challenging emerging markets. Pulling them off consistently is a huge hurdle. Their history of inconsistent profitability and negative free cash flow raises serious doubts about their ability to scale this model profitably. And that gross margin compression from the hardware component is a tangible negative trend. Plus, you have significant external threats. Intense competition, real geopolitical risk concerning Taiwan, broader macroeconomic headwinds that could derail government spending. And that high short interest is basically the market screaming its skepticism about whether Gorilla can overcome all these challenges.
Okay, and our educational DCF model landed on an intrinsic value range of $22 to $35 per share, but heavily dependent on execution.
Heavily dependent, the valuation range only holds if they successfully execute that aggressive growth strategy and manage to improve profitability along the way.
So where does that leave us? With the share price at $20.24.
Well, at $20.24, it's trading slightly below the low end of our estimated intrinsic value range. This suggests the market is definitely pricing in a significant amount of risk. But it also implies that if management does successfully execute, if they do convert that pipeline into consistent, profitable cash flow, then substantial upside could exist from here.
So high risk, high reward.
Exactly. It's a high-risk, high-potential reward opportunity. It's what you call a classic show-me story. They need to show the market they can deliver consistently. That stark division we keep mentioning, the bullish analysts versus the bearish short sellers, it perfectly highlights the uncertainty and the sheer magnitude of the potential outcomes. Gorilla is truly at a crossroads.
So, considering everything we've unpacked for you today, Gorilla Technology's future really does feel like it hinges on a razor's edge. What stands out to you as the biggest factor that will determine its destiny? Is it the sheer ambition and size of that multi-billion-dollar pipeline? Or is it their ability to meticulously execute on every single one of those complex, high-stakes projects? Something to think about. That wraps up our deep dive into Gorilla Technology Group, Inc. If you found this insightful, please do like and subscribe to the Stock Analytics AI YouTube channel. And remember, our $4.99 a month members get priority deep dives on tickers. We're actually covering all the S&P 500 stocks over the next few months, and members get exclusive priority access to those. If you just want a one-off deep dive on a specific stock that interests you, just drop us a super thanks on the video. And finally, a crucial reminder for you. This analysis was generated by an AI system. It's for educational purposes only and should absolutely not be considered financial advice. Please always conduct your own thorough research or consult with a qualified financial advisor before making any investment decisions.
Thank you for joining us on the Deep Dive.